Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Today I want us to do a revision question. November 2017 question 4. 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 This is CPA, November 2017 question 4. This is a question on company accounts. This is a question on company accounts. So it is on company accounts, and we are told in this particular question, November 2017 question 4, the following trial balance was extracted from the books of Nightshade Limited as at 30th of September 2017. Land and building 151,000. Everything is in shillings. Motor vehicle at cost 60,000. Accumulated depreciation. Motor vehicle 15,000. Purchases and sales. Inventory, revenue and reserves, general expenses. Salaries and wages, electricity, bank balance, interim dividend paid. Motor vehicle expenses, insurance, discount allowed and discounts received. Bad debts written off, accounts receivable and accounts payable, debenture interest paid, ordinary shares of shillings 40 per value, share premium 8% debentures, cash in hand director's fee, and then we have additional information. Goods costing 710,000 purchased on credit on 29 September 2017 were in transit, but we have purchased the goods. We have purchased the goods in transit and therefore had not been entered in the books by the close of business on 30th of September 2017. Inventory as of 30th September 2017 was valued at 112,300. A debt owed the company 1.5 million was declared bankrupt. His debt has not yet been written off. Allowance number 4, allowance for doubtful debt is to be set at 2% on the outstanding debt receivables. Number 5, depreciation is to be provided on motor vehicle at a rate of 20% per annum on cost. Number 6, as at 30th of September 2017, outstanding motor vehicle expenses amounting to 125,000 were prepaid insurance, while prepaid insurance amounted to 1.15 million shillings. Invoices issued amounting to 950,000 had been completely omitted from the records as at 30th of September 2017. Provision is to be made on outstanding debt, debenture interest, and the corporation tax of 22,975. The directors have proposed a final dividend of 2.5 million. It is very, very important to learn to do your workings. It's very, very important to capture everything in your workings, because from your workings, you prepare the final accounts. We are told that goods costing 710 were purchased on credit. Were purchased on what? On credit on 29th of September, only one day before the end of the month. They were in transit and therefore had not been entered in the books by close of the business. So the goods were not recorded. So we never recorded the purchases, and we also never recorded the creditors. We never recorded the purchases, and we also never recorded the creditors, the accounts payable. So if we get our purchases, and you see it is 12 from the trial balance, it is 1204,000. It is 1204,000. It's balance brought down. And the creditors, our accounts payable, is 100. Balance brought down, it is 700. And we are told our purchases are increasing with 710. We have not recorded it, so we record 710. And our liability is increasing with 710. And also our closing inventory. We never sold it. Our closing inventory is also increasing. Additional information number 2 tells us that our closing inventory as of September 2017 was valued at 112,300. So we need to add 710. To get the closing inventory. So if you were to do it that way, purchases 1204. This will automatically be 1204 710. This will be 0110 13 113 010. 113 as our closing inventory. 113,010. Then we were told additional information number. That is what we did in number 1. Number 2, we have sorted out that. Number 3, we are told a debtor who owed the company 1.5 was declared bankrupt, and therefore our accounts receivable need to be reduced. Our accounts receivable needs to be reduced. The balance brought down. Writing off is removing it from the books of accounts. Our accounts receivable is 136,500, and therefore we reduce it with the bad debt. Bad debt expenses amounting to, we are told, 1,500. And we have bad debt expenses account. If you go to trial balance, you get the balance brought down of bad debt expenses. In the trial balance, it is data 50. It is data 50 from the trial balance, and therefore we add this one, 1,500, and you see it's coming from accounts receivable. Giving us 554. So our total bad debt expenses become 4550. And then we are told that allowance for doubtful debts to be increased by 2%. Now, if you read, it's very, very important. Very, very important that you learn to connect various additional information. Because if you read number 4, it is connected with the number 7. Because we need to calculate the provision for doubtful debts on outstanding debtors. But there are some debtors who are not included in our accounts receivable. If you read number 7, we are told invoices issued amounting to 950,000 had completely been omitted from the records as at 30th of September 2017. Now, we invoice when we sell goods on credit. And therefore we needed to credit sales as we debit accounts receivable. So we need to add our accounts receivable with 950. And then our sales account. Our sales account increases with 950. Balance per TB on sales. It is 1574,050. It is 1574,050. It is 1,574,050. 1574,050. So we increase our sales with 950 because it was completely omitted. We never debited the receivables, we never credit sales. So we debit receivables through sales account, and then the sales account, you come in and say accounts receivable are 950. You must take a lot of care. You must take a lot of care. At times now when you are going to do your income statement, the temptation is to go to the income statement, to the trial balance, and get your sales. But you can see our sales is not what is in the trial balance. Our sales is the adjusted figure. Our sales is the adjusted figure. So we say 1574,050, 1574,050 plus 950. That now becomes our new debtors. 1574, 1574, 050, 1574, 050 plus 950. Plus 950, we get 1575,000. 1575,000. Now, that is our sales. That is our sales. What about our accounts receivable? Our accounts receivable, we add 950, but we subtract the bad debts to know the closing balance of debtors. The closing balance of debtors, after deducting bad debt expenses, that is where we apply the provision for doubtful debt rate. That's why we apply the provision for doubtful debt rate. Always remember that we get the accounts receivable, we subtract bad debts, the remaining debtors, that is where we apply the rate given. That's where we apply the rate given. So 136,500, 136,500, that is our accounts receivables, plus 950, we get a figure of 137,450. We get 137 for what? 450. Then we subtract our bad debts. We subtract 1,500 our bad debts. We get a figure of 135,950. Now this is our closing debtors. Our closing debtors, and it is on this that we are now applying the rate of 2%. Number 4, you are told allowance for doubtful debt is to be set at 2% of the outstanding receivables. The receivables after you have deducted the bad debts. So we come here and we say allowance for doubtful debts. Allowance for doubtful debts it is 2%. 2% of the remaining debtors. 135,950. 135,950. 0.02. 0.02 of 135,950. We get a figure of 2719. 2719. In our balance sheet, we will capture this figure of 135,950 and then we subtract 2719 to get the net debtors, which will be captured as our current asset. Number 5, we are told depreciation on motor vehicle at the rate of 20% per annum. Motor vehicle depreciation 20%. So 20% per annum on cost, on original purchase cost. So our motor vehicles from the trial balance is 60,000. 60,000 times 60,000, and therefore 0.2 of 60,000 is 12,000. 0.2 of 60, it is 12,000. It is 12,000. So our depreciation on motor vehicle this year is 12,000. So we say 12,000 plus the depreciation at the beginning of the year to get the depreciation. This will take to the income statement as motor vehicle depreciation expense, but to get the amount to deduct from the balance in the balance sheet as a non-current asset, we get the opening, the accumulated depreciation at the beginning of the year. We add the charge for the year to get the balance, the balance sheet balance. Then we are told number 6. As of 30th September 2017, outstanding motor vehicle expenses amounted to 125. So motor vehicle expenses, they were not paid. Some of them were paid, others were not paid. So from the balance sheet, we get the balance brought down in the balance sheet. Motor vehicle expenses, it is Motor vehicle expenses 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 44.75. 44.75. And we are told we have that's what we have paid. That's what we have paid. But we are told we have outstanding. Outstanding means has not been paid, amounting to 125,000. So we add 125, but we know it is a payable. Motor vehicle expenses. Motor vehicle expenses payable. Motor vehicle expenses what? Payable 125. So it's a current liability. So motor vehicle expenses payable. Payable. The corresponding credit should be motor vehicle expenses payable. So 44.75 plus 125, we get a figure of 4,600. We get a figure of what? 4,600. So we debit motor vehicle expenses to record the incurred motor vehicle expenses, although not paid, and we are supposed to credit motor vehicle expenses payable with 125. This is very important because when we are doing our income our financial statements, we will be looking at this. We will be looking at this. Then we are told, well, prepaid insurance amounted to 1150,000. So if you go to insurance account, the balance brought down. The balance brought down from insurance account. It is 7150. 7150. We are told, although we paid for insurance 7150, it's not every insurance that was spent. We have an insurance of 1150 which is not spent. If it's not spent, we carry it down to the next to be spent next accounting period. We don't record it as an expense. We don't record it as an expense. Whatever has not been spent is not an expense. We don't take it to the income statement as an expense. We only take what has been spent. 7150 minus 1150 is 6,000. 7150 minus 1150 should be 6,000. Yes, it should be 6,000. So we take to the income statement insurance expense of 6,000, but prepaid insurance for the current assets amounting to 1150. Invoices we have discussed, number 7. Number 8, provision is made for the outstanding debentures. Or even if we are not told, you must get the debenture expense, debenture interest expense, get the debenture interest expense. First of all, you calculate debenture interest expense, even if the question does not tell you. Some questions will not even tell you. But they will show you the amount paid and the interest rate. So our debenture interest rate is 8%, 8% of 60,000. 8% of 60,000. 80% of 60,000. That is 4,800. 0.08 of 60, 1, 2, 3. It is 4,800. It is 4,800. 4,000 what? 800. That is the expense. That's what we incurred. But that's not what we paid. That's not what we paid. Debenture interest paid was 2,400 from the trial balance. From the trial balance, less debenture interest paid. Less debenture interest what? Paid of 2,400, and therefore debenture interest payable. Debenture interest payable. It is 2,400. It is 2,000 what? 400. Directors propose a final dividend of 2.5 shillings, 2.5 shillings per share. 2.5 shillings per what? Per share. So we need to know the number of shares. We need to know the number of ordinary shares. We need to know the number of ordinary shares by dividing the ordinary share capital with the par value. By dividing the ordinary share capital with the par value, and we know ordinary share capital from the trial balance. Ordinary share capital from the trial balance is 160 million. Is 160 million. So we want to know how many shares do we have in this company. You divide by the par value of 40. The statement shows very clearly. Ordinary shares shillings 40 par value. 40 par value. So you divide by the par value, which is 40. You divide by par value, which is 40. You get a figure of, I think, 4 million. 160, 1, 2, 3, 4, 5, 6. Divide by 40. We get 4 million. We get 4 million shares. Now, the company has 4 million what? 4 million shares. And every share is getting 2.5 shillings. Dividend per share is how much? 2.5 shillings. 2.5 shillings implies total dividend expense. Total dividend expense, it is 4 million times 2.5, which is equal to 10 million. Which is equal to 10 million. That is, please mark, we are told it's a proposal. It's a proposal. It's a proposal. It's not a payment. Therefore, we will debit the income statement as we record a liability, dividends payable, which should be shown as a current liability in the balance sheet. Which should be shown as a current liability in the balance sheet. And quickly, that is how to prepare those are the workings that we're supposed to have done to get our financial statements. So we quickly now go to preparation of the income statement. Nightshade Limited income statement for the year ended for the year ended 30th of September 2017. So we get our sales, but remember our sales, we did an adjustment to our sales. We did an adjustment to our sales. Our sale is not also in the trial balance. The temptation is to go to the trial balance and get 1574.05. But our sales is not 1574.05 because there were some sales which were not recorded. So our final sales is 1575,000. Our final sales is 1575,000. I hope you are following me. So we don't have sales returns, so we less cost of goods sold. Cost of goods sold. And we say our opening stock from the trial balance. If you get the trial balance, we get our opening stock to be 91,000. Our opening stock is 91,000. 91,000. We add purchases. We add what? We add purchases. And our purchases again have been affected. Our purchases again have been what? Affected by creditors. Our purchases has been affected by creditors. So we say it is 120, 1204,710. It is 1204,710. It is 1204,7 what? 10. So we add the two, 91,000, 1, 2, 3, plus 1204,710. We get a figure of 1295,710. 1295, 7 what? So we less closing stock. These are cost of goods available for sale. We less closing stock. Less closing stock. I want to repeat again. Even when you are doing your workings, never write COGAS. Always write in full. Cost of goods available for sale. I'm doing that because I don't have space. So our closing stock from the trial balance, our closing stock from additional information number 1. Our closing stock from additional information number 1 is 112,300. But you must never forget, number 2, 112,300. But you know we increased it with the purchases of 710, which are not arrived. These are the ones which were in the office. These were the ones which were in the office, but there are some goods which we had bought and they were coming. And therefore we added 710 to what was in the office. 113,010. 113,010 to give us a figure on 1295 minus 113,010. 113,010, we get a figure of 1182,700. 1182,700. 1182,7 what? 700. So we deduct from our sales. We deduct these are cost of goods sold. Cost of goods sold. We deduct from our sales 15,700 minus 15,75,000. 1575, 1, 2, 3. We get a figure of that 393, 300. 393, 300. 393, 300. 393 what?
300.
393, 300. Always remember your format in the head so that as you do your question, you are following your format. You're following your what? You're following your format. So we always say, once we get the gross profit, we always ask ourselves, do we have other incomes? Do you have other what? Other income. So in our case, we do have. So we say other incomes. We say other incomes. We say other incomes. And if you go to the trial balance, you realize you have discount received. You have discount received. You have discount received amounting to 8,300. Discount received amounting to how much? 8,300. So we add 8,300. We get a figure of 400, 600. We get 400, 600, and that gives us aggregate income. What does it give us? Aggregate income. Overall income. Overall income. Then we say less expenses. Less what? Never forget my rule about expenses. Never forget about my expenses. You first of all look at the expenses where we have done adjustments, and then you go to trial balance. You ask yourself, what is it that we never adjusted? The expenses which were adjusted, then the expenses in the trial balance which we never adjusted. So you walk through this. You have bad debt, 4550. Bad debt expenses, bad debt, 4550. You don't have to waste your time saying bad debt expenses because you are saying less expenses. So the list we are having below there is expenses. Then we have allowance for doubtful debt. Never forget that allowance for doubtful debt, if we have opening and closing allowance, it is the difference which we take to the income statement. It is the difference between opening and closing that we take to the income statement. If it is increasing, we record it as an expense. If it is decreasing, we record it as an income. But in our case, if you look around through the question, we do not have anything like a provision for doubtful debts in the trial balance, meaning that this is the first time we are providing. This is the first time we are doing what? We are providing, and therefore we say allowance for doubtful debts. Allowance for doubtful debt. Know the difference between allowance for doubtful debt. Allowance for doubtful debt is not writing off the debt. It's only providing. We are using the conservatism principle. Allowance for doubtful debt. Allowance for doubtful debt. We are using conservatism principle to provide just in case. We are not writing it off. We are recording it just in case they fail to pay. 2719. 2719. And then motor vehicle depreciation, 12,000. Depreciation, motor vehicle, 12,000. The motor vehicle depreciation, 12,000. And then we talk to motor vehicle expenses. Motor vehicle expenses. Motor vehicle expenses. Motor vehicle expenses amounting from the working 4,600. 4,600. We are just going through our workings. We're going through our workings. Insurance expense 6,000. Insurance expense 6,000. Insurance expense 6,000. Debenture interest expense. Debenture interest expense. It is 4,800. It is 4,800. And then ordinary share capital, debenture interest expense, and share capital dividend. So those are the expenses which we did adjustments. Those are the expenses which we did adjustments. And therefore, we now go back to trial balance to find out the expenses which we never did adjustment. We go back now to trial balance to find expenses which we never did adjustments. They include general expenses of 2325, general expenses 2325, general expenses 2325. This is from the trial balance. This is from the trial balance. General expenses 2325. Then salaries and wages. We never adjusted salaries and wages. We have salaries and wages. We have salaries and wages. We have salaries and wages amounting to 244,150. 244,150. 244,150. 244,150. We have electricity 5,600. We have electricity 5,600. 5,600. We have bank balance, interim dividend paid, motor vehicle expenses. Motor vehicle expenses we have captured. Insurance we have captured because we have did adjustment. Discount allowed 10,900. Discount allowed 10,900. Bad debts written off. We should have captured it. We should have captured bad debt written off because it's one of the adjustments. Yes, 4550. Yeah, we have actually captured it. This one, bad debts 4550. Accounts receivable, debenture interest. Debenture interest we have captured. Debenture interest we have captured. Ordinary share premiums. So director's fee 40,000. Director's fee 40,000. Director's fee 40,000. So we try to add them up. We try to add them up to find out whether we are moving well. So we get 4550 plus 2719 plus 12,000, 12,123 plus 4,600 plus 6,800 plus 2325 plus 244,150 plus 5,600 plus 10,900 plus 40,123. We get a figure of 337,644. We get a figure of 337,640 what? That is total expenses. That is total expenses. So we get profit before tax. Profit before tax. We subtract from the aggregate income, we subtract the total expenses minus 400, 600. We get a figure of 62,956. 62,956. That is our profit before tax. That is our profit before tax. So we subtract less income tax expense. Less income tax expense. And we said, always look at your workings. Ensure that you put everything in your workings so that you are able to find out everything. So, where is our income tax? We like we didn't write our income tax. But the question tells us additional information number 8. Corporation tax. Provisions is to be made for starting debenture interest and corporation tax of 22,975. 22,975. 22,975. You subtract that minus 62,956 minus 22,975. We get a figure of 39,981. 39,981. Now that is the profit after tax. That is profit after what? After tax. Then we subtract income. We have gotten the profit after tax. Now we pay dividends. We pay what? But we know we're not paying dividends. Some of the dividends was paid and some of it was declared. Whatever was paid becomes an expense which has been paid, but what is declared is still an expense which has not been paid. So we talk about interim dividend. Interim dividend is what has been paid. Interim dividend. We are told that interim dividend is 7,000. 1, 2, 3, 4. 1, 2, 3, 4. Interim dividend is 7,000. What was paid in the trial balance? But we talked about dividends amounting to 10 million. We talked about dividend amounting to what? 10 million. But we say it is not paid. Although it's an expense, it is not paid. It is an expense that is not paid. So you deduct it here. Final dividend of 10 million, giving us total dividend amounting to 17 what? 17 millions. Total dividend amounting to 17 million. 39,981 minus 17,000. We get a figure of 22,981. You get a figure of retained earnings, 22,981. That is retained earnings for the year. Retained earnings for the year. That's what we retained from this year. So we add retained earnings brought down. And I've always said that the word retained earnings, it is used interchangeably with revenue reserves. It can be used interchangeably with revenue reserves. So if you look at your trial balance, you find revenue reserves. So add revenue reserves, 66,700. 66,700 to get the closing down balance plus 66,700. That gives you the closing balance of 89,681. 89,681. That is the closing balance, the revenue reserves. You can call it separate reserves or retained earnings carried down. So that's the figure that we take to the balance sheet. That's the figure that we take where? To the balance sheet. So we can actually bring it here. We can bring it here so that we know where to get it from. Actually, we are through with the issue of purchases. We only need creditors there. So we can here revenue reserves, retained earnings or revenue reserves. We keep it here, 89,681. 89,681. When we are getting shareholders' funds, we will capture retained earnings as 89,681. So from there, we do the balance sheet. We do the what?
Balance sheet.
We do the balance sheet. We do the balance sheet. We do the balance sheet. We do the balance sheet of the company. We do the balance sheet of the company. I hope I'm helping you. I hope you are enjoying my workings. I hope you're enjoying what we are doing. And if you think we are helping you, and I know we are helping you, I want to urge you, please subscribe, like, share, hit the notification bell so that anytime we are loading these very, very good videos, you are able to benefit from them. You'll be among the first one to benefit from them, and you are also supporting us. You are also encouraging us to continue helping many other young people who are studying this course. Thank you very much. So we go now to the balance sheet. We now go to the balance sheet. We go to the balance sheet and we say Nightshade Limited statement of financial position. Statement of what?
Counting.
Of financial position. Asset 30th September 2017. And we're saying always start with assets, then we come to non-current assets. Non-current assets. And we say there is cost, there is provision for depreciation, and there is net book value. Is that book value? If you look, remember our assets are supposed to be recorded based on the most permanent first. So we start with the land and building at 151,000. Land and buildings, 151,000. And we know everything is shillings and in what? Shillings in thousands. Shillings in thousands. Now, our land is not being depreciated, so 151,000. The next one is motor vehicle. And we know that our motor vehicle, we depreciated and we got the depreciation for the year. Motor vehicle depreciation is 60,000. From the trial balance, we have the accumulated depreciation for the motor vehicle is 15,000. 15 plus 27 plus 12 is 27. 15,000 is what had been depreciated at the beginning of the year. You add 12, you get 27,000. You get 27,000. 27,000 minus 60,000, you get 33,000. We get 33 what? Thousands. We look around to find out if there is any other non-current asset, and it appears that we do not have any other non-current assets, and therefore we get a total of 184,000. What? 84,000 total non-current assets. Total non-current assets. So we come to current inventory or current asset. We come to total current assets, starting with what? Inventory. Starting with our inventory. And we say our inventory is changing. If you just go to the trial balance, and you capture your inventory as on 12,300, you are wrong. Because we had adjusted our inventory with inventory in transit. We added the inventory in transit. So our inventory is 113,010. 113,010 what? 010. Then we have accounts receivable. We have accounts what? Receivable. We go to the accounts receivable. We say that the balance carried down of our accounts receivable is 135,950. But we have a provision of 27,19. 135,950 minus the provision of 27,19. Minus the provision of 27,19. Minus 27,19. 135,950. 135,950 minus 27,19. We get a figure of 133,231. We get a figure of 133,291. 133,291. 133,231. 231. Then we ask ourselves, do we have any investments? Do we have any prepayments? And we say here under insurance, we say you have prepaid insurance of 1150. Your prepaid insurance of 1150. So we add prepaid insurance 11 what? 50. We add prepaid insurance of 1150, and therefore we go back to the trial balance. We check, do we have any investments? Because we always follow prepayments in short-term investments, bank and cash. So we find out we realize we don't have any investment in our question. So we go to bank. Do we have any bank balance? And yes, we have bank balance at the top there. 42,200. 42,200. Bank 42,200, and cash there at the bottom. Cash in hand of 9,000. Cash in hand of 9,000. Let's try to add them up. To see what we get. 113,010. 113,010 plus 133,231. 133,231. 133,231 plus 1150 plus 42,200. 42,200 plus 9,123. We get a figure. 113,010. 113,010 plus 133,231. 133,231 plus 1150 plus 42,200 plus 9, 1, 2, 3, we get a figure of 298, 591. 298, 591. 298 to 591. That is total current assets. That is total current what? Assets. So we add to the total non-current assets plus 184, 123. We get a figure of 482, 591. 591. That is total assets. That is total what? That is total assets. 482, 591. And then we say financed by. We say financed by equity and liabilities. Equity and liabilities. And then we say equity and reserves. Then we say equity and reserves. Equity and reserves. Always check. Always ask yourself, did you do any adjustments within any of those? Did you do any adjustments within any of those? And you can see we have not done any adjustments there. So we go straight to trial balance and we get our figures. We go to straight away to the trial balance and we get our what?
Yes.
We get our figures. Our figures, we're saying we have ordinary share capital amounting to 160. Ordinary share capital 160,000. We have share premium, that is 6,000. We have retained earnings. Retained earnings, which we said it is 89,681. We have retained earnings, which we said is 89,681. Retained earnings or reserves. Retained earnings 89,681. 89,681. So if you add them, 160,000, 16123 plus that is 6,000 plus 89,681, 89,681, we get a figure of 285,681. 285,681. 285,681. We say that is total shareholders' funds. Total what?
Shareholders' fund.
Total shareholders' funds. And therefore, we look now for non-current liabilities. Non-current liabilities. And we know that our non-current liabilities include something called 8% debentures. 8% debentures. And the amount for the 8% debentures is 60,000. It is 60,000. And from there, we go to current liabilities. We go to current what?
Liability.
Always check on your adjustments. Always check on your adjustments so that you are capturing the correct items. You are capturing the correct what? Items. So our creditors here, our trade payables here. Our trade payables here are 14, 1. So 100, 700. 100, 700 plus 710. 710. You get a figure of 101, 410. You get a figure of 101 what? 101, 410. Our figure of 101, 410 because there was a credit purchase. Because there was a credit what?
Purchase.
Which had not been recorded. So if you don't check this, you will find yourself making a mistake. So our accounts payable is 101, 410. 101, 410. On 1, 410. Then you check all the other liabilities. All the other liabilities which we have worked on are the ones which we have not worked on. So let's check on our current liabilities which you might have worked on. We said motor vehicle expenses payable on 25. Motor vehicle expenses payable, we say it is 125. Then debenture interest payable, 240. Interest payable, it is to what? 240. Interest payable is 240. Dividends payable is 10 million. Dividend payable is 10 million. So we ask ourselves, what about tax? How did we deal with the tax? Additional information number 9 tells us 8. Provisions to be made. Provision. Anytime we think about provision, we mean it has not been paid. Anytime we are talking about provision, we mean it has not been paid, and therefore it's an expense in the income statement and a current liability in the income statement. It's an expense in the income statement and a current liability in the income statement. We are told number 8, provision is to be made on outstanding debenture interest and corporation tax of 22,975. So we say tax payable, 22,975. 22,975. So if we add them now, we will get 101,410, 101,410 plus 125 plus 240 plus 10,000, 123 plus 22,975. We get a figure of let me repeat again. 101,410, 101,410 plus 125 plus 240 plus 10,000, 123 plus 22,975. We get a figure of the figure I'm getting, there's something I'm missing there. There's something. Yeah, we have a problem here. We have a problem here with the debenture. The interest payable is not 240. If you look at this one, the interest payable is 4,000. What was incurred was 4,800, but as what was paid 2,400, and therefore the interest payable is 2,400. So this should be 2,400. So if we now add them up, 101,410 plus 125 plus 2,400 plus 123 plus 22,975, we get a figure of 136,910. We get a figure of 136,910. 136,910. So that is the total current liabilities. Total current what? Liabilities. Total current liabilities. And if you now add total current liabilities with the total debentures and the total shareholders funds, we should find out where they agree with the total assets. So we add total non-current liabilities of 60,000, 123, plus shareholders funds of 285,681. We get 482,591. 482,591. 482,591. 482,591, and it's the same now as total assets. So we say equity and liabilities. Equity and liabilities. That's the way to do that question. And once again, if we are of help to you, kindly help us, support us by subscribing to our channel. Like, share, subscribe, and hit the notification bell so that when we post these videos like we are doing in many of them, we will inform you. We also do the online classes. We do the intensive revision classes. We do the syllabus coverage, and we are we have 16 years of experience. We have 16 years of training experience. I can assure you, you are training with the best. Thank you very much.